All right, welcome. So, you're familiar with the FIRE movement, okay? Financial independence, retire early. It's aggressive saving and smart investing, so you can retire years or even decades ahead of the workforce. But what if I shared with you the best way to get you there isn't index funds, but something far more powerful? Real estate. In this video, we're breaking down the exact roadmap for how you use real estate investing to build the passive income you need in order to retire early and live life on your own terms. Let's dive in. So it starts with your FIRE number. That is the holy grail number, the amount of investing dollars you need to achieve financial freedom. The classical formula is the rule of 25. You begin by taking your estimated annual expenses in retirement and multiplying by 25. If you need $80,000 a year to live, your target is $2 million. That's a direct take from the 4% rule, which states you can withdraw 4% of your portfolio in your first year of retirement and then inflate it each and every year thereafter. That $2 million portfolio at a 4% withdrawal gives you that $80,000. Now, the catch for early retirees, that 4% rule might not be conservative enough, and we'll see why shortly. This is the biggest threat to early retirees. The original 4% rule was predicated on a 30-year retirement. But if you retire in your 30s, 40s, or even 50s, your portfolio will need to survive for 40, 50, or even 60 years. That's a far longer duration, and that demands a more conservative approach. Employing a 4% withdrawal rate over a 50-year period starts to get iffy. The success rate drops. So, in a sure-thing situation on a 50-year horizon, the data show that you need to retreat from that to a more conservative withdrawal rate of 3% to 3.5%. It's a small adjustment, but it makes you need a larger portfolio to generate the same amount of money. So your real estate strategy is that much more valuable. So, what is the biggest risk to your early retirement? And I give it a name: sequence of returns risk. It's not concerning bad market years. It's concerning when they happen. If you encounter a large market drop in the beginning of your retirement, and you are forced to take assets out at a loss in an attempt to pay for living expenses, you can harm your portfolio irreparably. It will never be the same again. So how do we avoid this? In two ways. One, we use a dynamic spending strategy. Instead of taking out some fixed amount every year, come what may, you adjust your spending based on how the markets are performing. Visualize it as a budget in layers. Maybe 3% is spent on your bare essentials, the light staying on, and food on the table. And then you have another 1% for luxuries, like dining out or a short vacation, and a final 1% for splurges, like a fancy vacation or a new car. The key is that you don't dip into those luxury and comfort accounts until your portfolio's well. And the second, more powerful tool? Real estate. We take the steady, dependable cash flow from our rental properties and apply it to paying for that all-important 3% keep the lights on budget. This provides a solid floor of income to shield your stock portfolio from being dumped in a crash. It's your financial safety net. Okay, so to make this work, you need to be able to speak the language of real estate investing. You need to get proficient at 3 key metrics. The first is net operating income, or NOI. It's simple. It's all your property income minus all your cost of operation, taxes, insurance, upkeep. Notably, it does not include your mortgage payment. It tells you the unadulterated operating profitability of the property. The second is the capitalization rate, or cap rate. It's your NOI divided by what the property costs. It's a useful indicator to compare the risk and value of one property over another, or one market over another. A higher cap rate, in general, means a riskier neighborhood. But most important to us FIRE investors is the third one, cash-on-cash return. This is your pre-tax cash flow on a yearly basis. So that's your NOI minus your mortgage payment, divided by the amount of cash you actually invested, your down payment, and closing costs. This number shows you the leverage of power. It shows you, how hard is my cash working for me? This is the number that really creates your retirement income. You've probably heard location, 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 but in a FIRE portfolio, we have to change it to cash flow, cash flow, cash flow. Appreciation is great, but it's icing on the cake. Monthly cash flow that you can rely on is the icing. It's what covers bills in retirement. So your market selection has to weigh most heavily those markets that consistently return good cash on cash. Generally, that's 7 to 10% range. You'll typically find those in growing secondary cities, not necessarily always the superstar high-cost metros. That requires serious homework. You have to do the math on local employment trends, house prices, what rents actually sell for, and occupancy rate. And here's a tip. Phone the local planning agency. Find out about zoning rules and proposed developments, because a new freeway or big new factory coming into town can completely rewrite the long-term math for your property. Now, how do you get started, especially when you don't have a lot of money? My favorite entry strategy is house hacking. It's your high-impact, low-cost entry into real estate. This is how it works. You buy a multi-unit property, i.e. a duplex, triplex, or fourplex. You live in one unit and you rent out the others. The concept is that your rental income is covering most, if not all, of your total mortgage payment. You are essentially paying nothing in terms of rent, or at least coming very close to it, while building up equity and getting hands-on experience. And the best part? You can do owner-occupied financing, so you need to bring in only 3.5% to 5% down, instead of the 20 to 25% you'd otherwise have to bring in on a straight-up investment property. It's a doozy. When you're doing it, this is the engine that is going to supercharge your portfolio growth. It's referred to as the BRRRR method, and it is buy, rehab, rent, refinance, and repeat. It's a process of recycling your capital so that you can reuse the same original pool of cash over and over. You first buy a distressed or undervalued home. One key rule is the 70% rule. Your purchase price and rehab cost shouldn't exceed 70% of what the house will be worth once it's rehabbed. That's your cushion. Then you rehab it. You make intelligent, high ROI upgrades, kitchen and bathroom updates, not gilded gold faucets. And then you rent it out to a quality tenant, creating a regular stream of income. Now the magic trick. You refinance. You go to the bank and get a new appraisal based on your property's now higher value. You take out a new, larger mortgage, pay off the old one, and this is where the magic comes in. You take your initial down payment and renovation charges out in cash. And then you repeat. You use that cash you just got and repeat the whole process on the next home. This is how you scale fast without having to save for every new down payment. As you get older, you'll want to move beyond single-family homes to multi-family buildings. That's where the serious scaling begins. Think about apartment complexes with 5, 10, or a dozen units. The advantages are huge. First, you have diversification of risk. If one tenant moves out in a single-family home, your cash flow hits zero. If a single tenant leaves a 10-unit property, you still have 9 other tenants paying you. It's night and day. Second, it's incredibly efficient. Instead of buying 10 separate houses with 10 separate mortgages and 10 separate sets of maintenance issues, you buy 10 units in one transaction, in one location, with one loan. It makes everything easier and accelerates your path to your FIRE number. When your portfolio grows, you will exceed the conventional bank home loans. Their income-to-debtor ratio will be holding you back. That's when you need to employ advanced financing. The first one you already know, the cash-out refinance, the focal point of the BRRRR technique. Other than that, you have portfolio loans. These are loans that are held in the own portfolio by a credit union or a neighborhood bank, so they can make their own more lenient rules. They'll lend on more complicated pieces of property and will frequently have more lenient debt-to-income ratios. The penalty is usually a bit higher rate and 15 to 30% down payment. And then there are private money loans. This is private lending company money or individual investor money. They are all speed and flexibility, often making the loan more sensitive to the potential and equity in the property than your credit rating. They're perfect for quick purchases or bridge loans, but you will pay an interest premium for speed. Uncle Sam is truly one of your biggest benefactors in real estate if you know how to play the game. Number one is depreciation. The IRS lets you deduct part of the value of your property annually, so long as it's deteriorating. For residential property, that's greater than 27.5 years. It's a huge non-cash deduction that protects your rental income from taxes. You can supercharge this with a cost segregation study, which breaks the property into components you can depreciate much more rapidly, over 5, 7, or 15 years. But pay attention. The 100% bonus depreciation, which allowed you to write off a huge chunk up front, is disappearing. It drops to 20% by 2026. That means you have less upfront tax savings, so your deals need to have improved inherent cash flow to compensate. Another wonderful tool is the 1031 exchange. This permits you to sell an asset, put the proceeds into a new, like-kind asset, and defer paying any capital gain taxes. Rules are stringent. You need to spot a new asset in 45 days and close in 180 days. But it's an excellent means of having your capital working and growing tax-free. Not an option. You have to have your business assets in a different bucket from your personal assets. The best method of doing this is by holding your properties in an LLC, a limited liability company. This creates a legal wall. If something happens to one of your properties, a lawsuit, for example, you're generally protected as long as your personal home, your personal bank accounts, and your car are on the hook. On top of that, an LLC gives you pass-through taxation. The company itself doesn't pay tax. The profits and losses simply flow through to your own tax return. So you avoid the double taxation corporations face. It's protection and economy all in one package. This is a critical decision on your path to passive income. Do you manage the properties yourself, or do you hire a professional? Self-management saves you money, about 8 to 12% of the monthly rent, but it costs you time, stress, and it's by no means passive. You're on call at midnight for toilet overflows. Professional management, though it takes that 8 to 12%, buys your freedom back. They handle the tenants, the maintenance, the leasing, and a good manager will actually pay you money by keeping vacancy times down and eliminating bad tenants. For true fire intent of passive income, professional management is almost always worthwhile at a cost. Never, ever fall in love with a property before you've conducted research. Careful due diligence is what separates the professionals from the amateurs. This involves a 3-part analysis. First, a financial analysis. You need to analyze the historical income and spending, look at the utility bills, guess at your own cash flow, and ensure there are no hidden liens against the property. Second, legal analysis. Get a title report, check all the current leases, and study any previous legal battles or code violations. And third, a physical inspection. Hire a professional inspector to find all the deferred maintenance, get environmental reports if needed, and verify zoning is correct. Not doing any of these is a recipe for disaster. Be realistic. Real estate isn't risk-free, but we can manage it. First, economic risk. Interest rates may rise, or there can be a recession, reducing tenant demand. We prevent this by buying cash flow positive properties up front and having a sense of where we are within the cycle of the market. Second, tenant risk. The tenant can be late paying rent, can damage the property, or can generate high turnover. Our solution is a bulletproof system of strict screening, and you guessed it, a great property manager. And third, location risk. The regional economy can get into a slump, crime can increase, or the area can be hit by natural disasters. We fight against this with that intense market research we talked about earlier, focusing on areas with economic stability and good long-term potential. So, how does it go? Your winning file portfolio is a hybrid. It's not pure real estate. It's the marriage of real estate cash flow with your more traditional stock and bond investments. You start with Phase 1, market entry, purchasing that first cash-flowing property. Next, Phase 2, stabilization, when you optimize its performance. Next, Phase 3, the scaling phase, and you use the BRRRR method and other strategies to rapidly expand your unit base. And finally, Phase 4, the FIRE transition, in which you move from growth at any cost to stable, predictable income generation in order to fund your life. This is where it all happens in retirement. Recall that tiered budget and dynamic spending we talked about? This is when it gets serious. We invest our steady, consistent rental income, the cash flow that just keeps rolling in, month after month. The money we apply to cover that essential 3%, keep the lights on aspect of our budget. That's for house, food, utilities. Then we just leave our finicky stock and bond portfolio alone. We touch it only for our luxuries and comforts when the market is booming. By taking that step, we are structurally protecting our entire financial plan from sequence of returns risk. The basics are covered, no matter what is happening with the stock market. And one last extremely important point, real estate is cyclical. It has highs and lows. If you are buying at the peak of a red-hot market, you will likely experience a flat period where your expenses are rising faster than you can raise rents. You must be prepared financially and emotionally for this. You build a strong portfolio with adequate cash reserves to ride out the down cycles. Because the large rental increases and appreciation generally don't happen until after you've weathered a full cycle. Now's the final piece of the puzzle. Early retirees, you can't access your 401k or IRA until 59 and a half without a penalty of 10%. So what do you live off in your 40s and 50s? Your real estate portfolio is the perfect bridge. The tax-advantaged rental income due to all the depreciation write-offs provides you with the cash you need to pay for your lifestyle expenses for years to come, allowing your traditional retirement accounts to continue compounding untouched until you can access them penalty-free. It's the perfect 1-2 combination. So in short, achieving FIRE using real estate is all about attitude. It's a numbers, leverage-based strategy. You must calculate your number using a conservative 3% to 3.5% withdrawal rate. Your success hinges on selecting high cash-flowing markets, mastering the BRRRR model to recycle your capital, leveraging sophisticated financing when needed, and being tax-aware. With the elimination of bonus depreciation, focus even more on picking deals with strong intrinsic cash-on-cash returns. And finally, build that defensive financial backbone where your rental income covers your necessities, protecting the rest of your portfolio. It's a disciplined, doable path to true financial freedom. Thanks for watching, and I'll see you in the next one. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.